right. Welcome everybody to our panel on cracking the Series A in climate tech. We're joined today by investors from Greencode Ventures, Future Energy Ventures, and Intelis Capital, which we'll get into introductions for them pretty soon. I'm Alex Katzmann. I'm one of the founders of Growth Inflection, here along with Stefan Langin. We're going to be hosting the event today. Really excited to dig into this challenge. Growth Inflection, we got started with the mission of helping accelerate growth for early stage companies in the climate tech ecosystem, and trying to get as many solutions to scale as possible. One of the things like we're excited about today is that there's a challenge with raising Series A. It's a bit harder than it has been in the past. If you look at Carta, has reported some data that over the last 6 years, the baseline amount of startups that are able to go from seed to Series A within a 2-year period is at 25% and higher. And when we look at data recently, within the last year or so, it's only about 12%. So half of the startups compared to the typical baseline over the last 6 years are able to raise Series A. So we want to kind of dig into that a bit with folks who are actually out there investing on the front lines, see if we can give some advice, tips, feedback to help folks navigate this and get to where we want to go, which is more solutions to scale to decarbonize. So before intros, real quick housekeeping. We'd love to have your feedback and comments as we go. Please feel free to drop anything in the chat. We'll try and work it into the conversation as we're going. Please do stay on mute though, so we can keep the audio clear. And then with that, I'm gonna start for intros with Ines. I think if you could just give quick kind of background about yourself, maybe a little bit of a fun fact and what you're focused on in the climate tech space.
Mm-hmm. Yeah, hello everybody. Great to be here with you together today and with this fantastic panel. So my name is Ines Bergmann-Nolting. I'm from Greencode Ventures. Greencode Ventures is a fund focusing on the green transition. Precisely, we're investing in early stage European companies with digital business models and who are all with these business models accelerating the green transition. We invest early stage, and for this means seed and typically Series A. So being a multi-stage investor, as I already said, European focused with a particular focus on the Nordic market and the DACH region. We're a team of 7 people, also spread out in these locations. I'm personally based in Germany, but we also have team members, and parts of the team are in Finland, Helsinki, and in Stockholm, Sweden as well. And that's also combined with our investment thesis that in particular within the European ecosystem, we're seeing many great climate tech startups coming from these areas. And that's why we're particularly present in these ecosystems. And yeah, about myself, so German, I already said, I'm based in the northwestern part of Germany, and my background is in energy and venture capital. Roughly 15 years of that. And yeah, it has been an exciting journey with Greencode to just kick that off recently. So we are a new fund, and in particular to mention Article 9 Impact Fund, and also a female-led fund, so something different in that space in particular. So yeah, great to be here today and looking forward to discussing Series A.
Thanks, Ines. All right, we'll move over to Giancarlo.
Super, thanks for having me. Appreciate it, and good to see you again. My name is Giancarlo Savini. I'm here with Future Energy Venture based in Palo Alto in the US. It's a VC firm investing in the best entrepreneurs, so essentially in the best teams in the digital space. We know climate tech since before he was so cool. Since 2016, Future Energy Venture invested in more than 50 companies, recognized by Bloomberg and Climate 50 as a top European players. We have these outposts here in Silicon Valley. We believe in these cross interactions between Europe and the US. It cannot be more important that in this period we definitely need to work together. Both markets are. We tend to think that they are big, but in reality, in aggregate, considering it at the global level, they're definitely not big enough. So I just want to share that we should definitely work more together. We believe in European companies that can expand in the US, leveraging the capital markets in the US. Hot topic in this week. We are raising our second fund, aim to be $273 million. Mainly, we're investing in companies that have 1 million revenues and are inflecting. So if you're inflecting and you want to inflect even and you want to grow even more, please talk to me. Fun facts about me: on my spare time, I volunteer at the San Mateo Country Jail. It's a great experience. I really get a lot out of it. And I don't want to drop any analogy between prison and venture capital, but it's definitely something that I am passionate. And if you want to talk about it as well and how to improve that, definitely come back to me. Nice to meet you again.
Great. No, thanks, Giancarlo. And that's a great fun fact. All right, over to you, Jonathan.
All right, great. Well, I'm Jonathan Crowder. I'm particularly excited to be here today because I think that this is a really urgently needed topic. So I am the founding partner at Intelis Capital. So Intelis Capital, like all the folks on this call, we invest in early stage climate tech entrepreneurs, particularly focused on the energy transition. And since it's funny, we call it climate tech now. Climate tech is many things. And so I always like to specify, we tend to invest in solutions that are selling directly to utilities, renewable developers, and those who love them. Generally speaking, those investments are initial investments from pre-seed all the way through Series A, typically in companies that have raised less than $15 million previously. We invest all the way from pre-revenue into reasonably substantial early stage commercial traction. And I think that actually that's one of the major topics that we have to talk about today is what are the various milestones that are associated, operational milestones that are associated with these different stages today. In terms of my background, I've been around climate tech since before we called it climate tech. I started my career at an environmental policy think tank in the Bay Area called the Breakthrough Institute, and then left to join a Kleiner Perkins-backed energy marketplace. We were part of the relatively ill-fated Green Growth Fund, although we were one of the lucky winners within that portfolio, a company called Choose Energy. I was an operator there for a few years, and then we sold that business in June of 2017, founded Intelis Capital to do this.
All right. Well, thanks. Got a good mix here. And so excited to start diving in. Stefan, over to you.
Yeah, let's start with the first question. How do you see the current state of climate tech funding, and how does your investment strategy align with the landscape? And I would like to start with you, Ines.
Mm-hmm. Yeah, thank you. No, I'm absolutely, of course, positive about the space. So it has been significantly growing, and relative to overall investment in venture capital in other areas, we still see that it's a growing area. So that is the very positive news and really makes us confident that we're at the right space, and it's not only the right thing to do for societies and for the type of businesses we're founding and supporting, but it's also financially an attractive space that we're looking into. In our view, I think what's happening in the climate tech space and with what we see as the broader green transition, we actually think it's the biggest capital reallocation that is happening in our times. So it's a great place to be. As I said, the number of investments relative to other areas and the money allocated to the space is growing. We're seeing a little bit a dip in compared to the high times in 2020 to 21, but overall still it's a very attractive area, and we are positive also for the future for the developments.
Okay, thank you. Yeah, I think what we haven't asked at the beginning is, are you hardware or software? But I think we are all software, digital here at the table, right? And so maybe Giancarlo, can you put a little bit more light on this? Kind of, you're also kind of a software investor, right? So
yeah.
Is there the current state of climate tech, maybe also kind of a view on what is the difference between digital and hardware in climate tech, from the investment point perspective?
Yeah, absolutely. Happy to answer that. So first of all, I'm just building up on what Ines mentioned. It's definitely a great time. If you look at last year, roughly 1.8 trillion were deployed in renewables in different type of asset classes, but the 1.8 and roughly 1 trillion in fossil, so almost double. So it's sometimes you get that negative outlook, especially looking at the public markets, but yet we need to recognize that almost double of the new investments in the energy space are happening in the renewable realm. So definitely positive side. On the software and hardware, of course, we're not naive. Energy is a lot about hardware and about developing new type of infrastructure, upgrading our grid. Definitely that's the case. We think that especially in the generation side, the technology challenge is somehow nailed. What we need to do now is to accelerate deployment, and to do that, you basically need to remove some friction points in the procurement side, in some of the bidding, in characterization of our assets, of our parcels or buildings, and in that respect, software can really help and have immediate results, almost instantaneous results when deployed at scale and with the right premises. So in that respect, we believe that the digital angle is still pretty much in need. On the grid part, on the generation side, on the mobility side, on the smart charging and all the interactions between the grid and how we are in our buildings and our vehicles. So those are three topics where software can really make the difference without mentioning, the old carbon markets and accounting that despite some of the controversial developments, it's still somehow constant and indeed would require software for quality improvements as well as trading. So that's I still see software as an integral and key part of the solution.
Thank you, Giancarlo.
If I may, if I may, I would happy to add, like as you asked about the software and the hardware angle. So I think we at Greencode, we also have a focus only on digital. So there can be some lighter touch hardware, but not the big asset type of business models. Nevertheless, I think for the green transition, for climate tech in general, I think we need both to really make that happen and to drive net zero as societies and forward. Nevertheless, I think why we chose to look very, in particular at this angle and the software and digital part, of course, you need a niche to focus on and where your expertise is. However, we also believe that in the short term and in the fund period of our fund, we can actually get the biggest impact in the space with the digital solutions. We, of course, need other people also to look at the other spaces, but for us, that's where we can make really an impact within the fund lifetime and within the next decade, and that's what we at Greencode looking for. So just like to share that perspective.
Thank you, Ines, for the further explanation. And Jonathan, to you, what is your perspective on climate tech in general and the bigger picture?
Well, I've certainly been spending my career on this because I'm tremendously optimistic over the long term. We are also, like the other investors on this call, we are primarily digital first, although we will invest in hybrid businesses, so digital hardware hybrids, where the software is over time, expected to be the dominant share of revenue. The hardware is what I would say is relatively simple, as in we don't invest in deep tech. I think actually that's one of the areas that historically has been undervalued in the conversation, in that we look at basically declining cost curves for solar and storage and wind over the course of the last 15, 20 years. There's been a tremendous amount of investment, most of it not venture capital investment, that's gone into reducing the hardware costs and the supply chain costs. And one of the areas that software has historically been incredibly successful in other industries is reducing soft costs. And those have been relatively a little bit more pernicious in renewables than in some other sectors. And only recently has that started to come down. And there's some tremendous climate tech success stories in that space. I mean, the one I think of most of all is Aurora Solar, but there are certainly others. And so we're incredibly bullish on the opportunity for software to continue to increase deployment of all the kinds of technologies that we're excited about.
Great.
Well, thank you.
Yeah. Great. Thanks for all the views here, and I think we're going kind of deep on the digital side of the house here today. So wanted to go into the Series A round, and kind of I set the backdrop of, the data shows that it's about twice as hard right now, at least, to raise Series A in the same time frame, under 2 years. So Ines, curious, when you're looking at a company that's interested to raise a Series A, how are you assessing them? Like, what metrics are you looking for? What are the things that you watch out for at this stage?
Yeah, thanks. Maybe before going into detail there, I'd like to mention one aspect, so a European view to the table here. So I think in Europe, what we see in the moment is that in particular pre-seed, seed, and Series A rounds are in the climate tech space. Companies are actually, if they're doing well, they're getting funded. So we're not necessarily seeing a gap there happening yet. So I think where we see a definitely a declining things happening is more on the growth side, so Series B onwards. And that's, I think, the major change we have observed. Of course, valuations are a different topic, but that's, of course, from our perspective, a positive development. Just as a short comment, and then now coming to your questions. So what are the things we're looking into in particular? So, of course, we also equally evaluate the topics. We look at the other stages, the team, the product, the market, the competition, the financials, all these things. However, different aspects become important. So I think just to pick some examples, so for us in the team space, I think it's not only anymore about the experience and the personality of the founder alone, but also, for example, what can they show in the trajectory of building a team and how they have scaled and how they are managing that team. So I think at Series B, I'm having a totally different expectation there already to the founders and the structures I'm looking forward to see. Then more on product side, I'm expecting to see a company that has really found product market fit and that is now ready to scale things, and that might not be still in search of certain aspects, but is ready. There might be, of course, additions, but that it's ready to scale at that phase. Then when looking more on the customer side, I'm definitely expecting to see traction. I'm expecting to see that there is already the diversified customer base that the company has and can show at that stage, even, and has with these customers the potential to keep them and to also upsell with those customers. So seeing that as positive proof points of their approach to the market as well. And then, of course, financials, we're expecting to see with these companies that, of course, they're having certain revenue levels. I think the magic 1 million ARR figure, of course, but of course, there it depends on the case, but the point is there should be, of course, clear tractions and traction and clear numbers to present at that stage. And in that space, another aspect that is really important from my point, I think, to see that the company is already showing how they handle their projections, how they're developing their budgets, that they understand that it's not guessing anymore, but that there is definitely a spot on approach with how they're handling those things. So those, I would already have different expectations in a Series A than in other areas. And market and competition wise, I think certainly that there is a differentiation at that point visible, that the company has either a tech advantage very clearly or has a clear follower position in the market where they are already playing. So just to highlight some of the aspects that are important for Greencode, for me personally, and we're looking at, but certainly there are more things, but maybe the colleagues are also happy to share their view, what is important for them.
Yeah, and I wanted to throw this out for anybody to answer too, is how important is pipeline and what do you all look for in pipeline at Series A? Do you have a certain pipeline coverage number you're looking at? Is it too early to be thinking about that? Just kind of curious, besides, revenue and some of the other things Ines talked about, how do you look at the pipeline in terms of where the trajectory is going?
Yeah, absolutely. I think pipeline is also a clear proof point, but I think to look forward-looking, okay, in what stages, and is it a real pipeline? At that stage, you should expect that, but also what can you see in conversion rates over the times, how are they doing at the different stages? So of course, these are very important metrics to look at, but then I think the very individual metric or KPI is also very dependent, of course, on the type of business model that we're looking at.
Makes sense.
I would definitely echo Inez's sentiment there that pipeline is extremely important, and particularly in these industries where Alex, Stefan, I know that you both have tremendous experience selling to utilities. The sales cycles are slow, and so one of the challenges with getting to, you mentioned, it's much harder to raise a Series A, in 2 years today than it was, say, 2 years ago. I think one of the big challenges for companies in this space is that if they're selling to renewable developers, if they're selling to utilities, often those are 6, 12, 18-month sales cycles. And so the timeline to reach visible product market fit through the lens of revenue solely is much more challenging to do in that relatively tighter timeline of 1 to 2 years. And so oftentimes I think that an important facet of raising a successful Series A today is really about how do we frame our non-revenue traction metrics? How do we give investors confidence that there's comfortably over 1 million in ARR that is going to be converted? It's just some of it hasn't necessarily, manifested yet.
Over to you, Stefan, for next one.
Yeah, I was checking one of your posts, Jonathan, kind of yesterday, and you're posting that or give guidance to founders when they are asking for money, and you describe it that it's a sales pitch. So you need to also ask questions, right? And listening is one of the major thing you should do, right? And not only presenting. And so the question for me is kind of what is next to the metrics. Let's say kind of they are moderate and you are fine with kind of 80%. What is then important with the founder? How should the founder behave if in the process of fundraising? What do you think makes the difference from a founder who is then successful in raising the Series A and the founder who is probably not so successful and with equally numbers, let's say, and with kind of similar potential? It's really interesting your perspective on this.
Yeah, it's such a good question. I think my answer is probably a little bit controversial. For me, most of the founders that I've seen be most successful in fundraising, and this is going to sound strange at first, act like they are less happy with their business. And what I mean is many founders come and they pitch as though the future is certain and the only thing that stands between them and success is just investment. And of course, they're there to raise capital and we're there to have the conversation about raising capital. But I find that founders that are most successful fundraising are incredibly clear about the areas of risk in their business. And they're transparent about those. And they say, these are the things that we figured out, and here are the reasons that we believe that we have those things figured out. And here are the areas where we're not good yet. These are the areas that are struggles. And I think that a lot of founders are hesitant to be transparent about those things. But and as Giancarlo, just disagree if you don't think this is true. But I've never seen a perfect business yet. I keep waiting. I hope it will happen. I've never seen a founder who, at the seed stage, had everything figured out and there was no risk left in the business. If that was the case, they would be priced too high and we couldn't possibly invest. And so I think that founders that show the self-awareness that building a business is an incredibly challenging endeavor, and they will not have all of the answers at seed, and that they're open and honest about here are the things we believe we know, here are the things that we hope we know, here are the assumptions we're making about the future, and here are the areas where I have questions. And I'm looking for someone who's seen thousands of startups like we all have to weigh in and provide insight and provide some additional direction. And so I think for me the key sort of behavioral feature is people who are honest about the current state of the business, understand the risks very clearly, and aren't pretending like they don't exist.
Yeah, I agree. Yeah,
I think
I can go ahead, Ines.
Okay, you go.
Oh, thanks. Yeah, the ultimate. I agree with you on the risk side. What I think it's really a compelling sales pitch, at least for me, is someone that yes, is selling the product. Yes, is basically highlighting all the upside potential, the road to the famous 150 million revenues. Which is the ultimate goal of VC firm. I always surprised how often founders are not aware of. VC funds are looking for those type of companies that can scale up that dimension. And we will see that the climate tech market, it's quite fragmented. So if you look at different sectors, it's often not really so easy to arrive at those dimension compared to other sectors. But the difference, in my view, is a founder that, while selling, is also mentioning or sharing some validation points. It's essentially validating some of his assumptions with real customer attractions, real, even a couple of POs or relatively limited revenues, but that somehow is argumenting their sales pitch with validation points. That's often goes a long way, rather than only pitching the rosy story. Risk, but also validation points that you are already somehow touched in with revenues from some early clients. That's often what that's often the differentiator in my view.
I think agreeing with what has been said by both before. I think this was said to be reflective. That would give it a different spin in the sense also of involving founders that early involve their network, their advisors, their investors, that necessarily not taking all advice, but also being able to listen at different points and adjust at different points. So I think that's also, I think, a valuable quality, and that for business, but then of course also for fundraising helps to be successful. And then I think in general, I think of course leverage your network, leverage your investors, and also after the round before is already the next round. So continue building relationships and be also communicative with the wider market for the next fundraise. I think that's also, I think, very important for a successful round, in particular in a successful round in difficult times. And then the investor has heard about what Giancarlo was asking for, these maybe some of the validation points over time that might be missing, and can see that how you're developing also over time, and gets proof and more confidence on the path and the way you're progressing.
Great. I think all super helpful and great tips. So one place I wanted to double click on, we'll ask you first about this, Giancarlo, is, before kind of the last couple years where, given kind of macro changes and just also kind of the VC bubble deflating that we got into after COVID, it was really much like entirely kind of focused around growth. And that was like a primary metric for VCs when looking at a company. Obviously, there were a lot of other considerations that we talked about, but growth really was paramount in terms of like, what does that trajectory look like, and can it get to the scale that you were talking about? The last couple of years, we've reset a little bit to where profitability is important with the change in interest rates and just overall, markets and valuations having to come down. There's been more of a focus on companies that have a business model that can get to there. And I'm just curious, has that shifted how you are looking at investing at Series A? Are you more focused on digging into path to profitability, or not?
Yeah, it absolutely. It's definitely more. One of the typical questions I'm hearing all the time is, cash conversion score, how conscious you are on the utilization of the capital that you have, runway. Those questions are popping up more often in the last couple of years than before. If you exclude 2021, which was somehow an outlier in funding deployment, I would say that was always let's say a point of focus. Now it's a little bit more with interest rate and everything you mentioned. However, I have to say, it's kind of the hot topic now to ask about growth and path to profitability. We also have to consider these are early stage companies. They often, even if they let's say even if they share a path, they often do not have a validation of that path. The other, so you always need to consider. I would be more interested in understanding more than seeing the positive EBITDA at a certain point in 2020 something. I would probably be more interested in the assumptions related to that growth. Essentially, how big is the problem for the customer? How sticky is your product? Can you really defend your gross margins? Those are of course, the cash conversion score, how much you're burning for the value you're creating. Those are the most important questions at this stage, rather than having a right Excel model showing a positive EBITDA in a few years from now. It's absolutely important, but I would focus more on those key validational points on the assumptions, especially how big the problem is for the customer. Is it a really solving, is it a painkiller or is it a vitamin? Because that is often driving how substantial your margin will be, and also how much you can defend them against competition. In the past, we actually did, of course now this is definitely a hot point, but in the past sometimes we did the opposite mistake. We focused on software companies that were selling to utilities. Of course, on paper had great margins, but the market essentially were selling to 6 or 7 customers in the US. So you could imagine, even if you have an outstanding path to profitability and good margins, the market itself was pretty thin, and then they had to pivot to increase their market by accepting a lower gross margins. So you always need to, I don't want to over rely on those topics now, because it's the flavor of the year. You always need to, if you've seen a couple of cycles, you know that you need to consider both at the same time.
Yeah. No, that's really good insights, and I think that makes a lot of sense to me. We actually got a question I think is a nice tangent from here, from Trevor, saying, we're closing our Series A. We have a term sheet in hand from a lead strategic investor. We've got traction with global automakers, have started generating revenues. As investors, do you trade off between length of sales cycle and revenue growth in your analysis? And anyone can take it.
I can start, yeah. If you want. The opposite side of the medal with sales cycle is stickiness, and we love that. Oftentimes, the real sales cycle of a utility is 5 years, and I'm always surprised how a lot of founders are not aware of it. It's 2 years pilot, 1 year really assessing, consolidating the pilot results, and then you have the real 2 years cycle. So that's the thing is that as soon as you are embedded in their procurement process, it's a very sticky project, especially for municipality or co-ops. They don't have competition, they pay well, and that's the sales cycle suddenly becomes a barrier for you. So I would, if you are having a longer sales cycle, but you are growing a little less, but you still have ways and means to navigate those long sales cycles, I would not consider it necessarily a negative point.
So maybe perspective from our end, what we like is, of course, that's a challenge, but of course we like companies who mitigate that issue with longer sales cycle industries, like what was mentioned, utilities or automakers, by basically having different segments to sell to, and being a little bit more flexible in the sense, and having different type of customer groups to still create an attractive case around that. But that's just one aspect.
I'll add just that I agree really strongly with Giancarlo. The way that we sort of frame it is, what is the ratio of sales cycle to lifetime value? And in the case of utilities in particular, they are one of the worst industries in the world to sell to, and they are one of the best customers that you can possibly have, because for many types of solution, lifetime value is effectively infinite. You know, there are plenty of utilities that are using the same vendors today that they used 20 years ago. And since they tend to sign relatively large contracts, every year is pretty material. And so the question is, are you taking whatever a realistic perspective of the sales cycle is and integrating that into the operating model in terms of how you think about building the business and how you're planning for burn rate? And so I think that this is a question of not certainly all else being equal, shorter sales cycles are better than longer sales cycles, and more certain sales cycles are better than less certain sales cycles. But you can operate within any sort of reasonable range of parameters there, as long as you have a realistic picture of what the dynamic of that sales cycle actually is and what the value of that customer is likely to be. And as Giancarlo mentioned earlier, have validation reasons for why you believe that's true.
You're welcome, Trevor. Good to have you here. Should I continue? I think so. We are really lucky today because we have I think the first panel with a European touch. So Ines is sitting in Europe and in Germany. Giancarlo moved from Europe, I think 2 years ago, to the US and is working for VC, which is a headquarter in Europe. So are there major differences between investments in the US and versus Europe, and you know, the size of the country, and you know, if there's a startup in Germany is, I don't know, 10 times smaller than the US, I think even more. So the market itself is smaller. Then, you know, if you want to then conquer other European states, there might be different regulations and especially in the climate tech space, maybe also different incentives. Is there can you give a little bit more color to this topic, and what are the benefits and the goals and the no-goes in these two markets? You know, talking about Europe and USA.
Yeah, certainly. So I think we invest, so at Greencode, we invest in European registered companies, but of course, we also like companies that at some point can scale and are interested in going to the US. And we already have cases in the portfolio where this is the case. So I think, what are we seeing in differences in the markets? I think I initially mentioned one. I think that we are in the climate tech space. I think we're still in Europe, that it's seeing sufficient capital going to that space and interest in those founders, and that fundraising is still working well, in particular in Series A and earlier with these companies. We're seeing, and that's also not necessarily a surprise, that valuation levels, even though they have gone up in Europe, still we are seeing a little bit different levels than and more reasonably priced in some areas than what we're seeing in the US. But we're also having this issue, and that has been before, and it's still continuing, that growth capital in many ways is often missing, and that this is the bottleneck for European companies in many ways. So I think those are some of the aspects. I think then in other particularities, I think either way is working, whether at some point, going from Europe to the US or vice versa. I think you just need to find the right moment for your business model, and when is the right timing to do that. And in particular, often at the beginning, it's the case that you still should focus, and then when you have the right size and the right structure, that then you can approach the next market. But you also should, of course, do it. I think it's easier to do it early if you have a product that does not need that adaptation. And in particular, if we're now looking again more energy market, what has been mentioned quite a lot, then often there is adaptation needed, and even in Europe, even more adaptation than in just one single country. So I think that's, of course, needs to be well thought through. With a general product, it's easier to do it early, that it's applicable independent of the geography earlier on. And of course, that's something we like and something that's interesting for us and business models, of course. But it's in particular, if you look at energy, that's often difficult. But broader climate tech, you find many business models where this is easily possible.
Okay. Understood. For me, kind of really, I'm interested myself in the answer of this question. If you are starting in Europe and a startup, and then you have all these regulations and obstacles in the other countries, but they have the same size or even smaller, and you're triggered for growth. Is there not a better option to go to a bigger market? I'm not talking only about US, maybe China or kind of Australia, or would this then not be more a better option? Giancarlo, what is your opinion about this?
Yeah, so you touched in my view, the most important point. If you really look at the climate tech space, energy is fragmented, is local. You have different flavors, different sub-markets that are intrinsically different. So if you really do an intellectual exercise on the size of these markets, you will realize that they're not extremely big compared to, I don't know, software enterprise or telecommunication. So you will realize that maybe solar is different, and e-mobility are definitely is definitely quite big, but all the others are quite fragmented. So what I'm trying to say is that the climate tech market, it needs to be Europe and US together. It needs to a company, if you want to be a market leader globally, which means that you want to be venturable, you want to have the 200 million revenues per year at a certain point, you will need to have you will need to get in both markets at the same time. And most of the time, there are only few sectors where you can make it only by staying in Europe or US alone. So in my view, having this dual approach is simply good business. There is no any other way to go around it. We need to think about Europe and US as one unique climate tech market. And if you think about it, if you look at solar or e-mobility or batteries, the sum of the two of Europe and US together in terms of market size is comparable to the one in China, or if you consider China and a few other countries together. So to be meaningful to be really meaningful in this market, you need to have that dual approach. There is really no way around it. And if you see that the biggest climate tech successes, if you look at if you look at all the companies that reach somehow the status of unicorn, 100 and 120 companies, depending on when you look at it, 2021, 2022, or 2023, they all have touched both markets in a significant and meaningful way. So that's my point of view. It's not a market where you can afford to stay in a couple of countries or in Europe alone.
Thank you. But is this not then more kind of a Series B topic, or is it also Series A?
Well, yeah, you want to see it. At least you want to see the potential to achieve that volumes even at Series A. You're right. Maybe you don't want to go to a different continent too early and lose focus, but at least it needs to be in the business plan, and you at least need to factor it in your growth sales pitch.
I think on this one, I like to put a little bit different flavor and maybe even contradict in a little way. So I think for me, it depends also on portfolio construction, how you think whether the companies you invest in and it necessarily need to tackle from market size both markets already. Of course, the later you want and you're investing, of course, it's a key parameter and also important for us to be investing in business models that can be category leaders and can be internationally scalable. But I think there are also very attractive businesses in that space that can make it in one or the other geography and can be still from a VC perspective an interesting game for us. So I think more positive signals to the startups that might be listening. So for us, it's not a factor that if you're just covering or one for the time being one market or Europe only or the US only, that we would say that's a no-go. We still think those markets by itself have a very interesting size, and the better, of course, the more the better, but alone it can be interesting. And then we look at it from a construction portfolio, what type of companies with what market sizes they are addressing do we want to be seeing in the portfolio, and find a mix across that.
Great. Well, we're getting very close to the end here, so we have one final question we wanted to get some thoughts on from each of you, because it's been a great discussion so far. I think a lot of really good actionable insights and tips that hopefully founders and startup teams can take away. But what have you seen both on positive and negative from recent Series A investments or other early stage investments in climate tech startups right now? You know, are there any insights, learnings, or things you'd like to share with folks that are, you know, going out into the fundraising market on what they can take away? And maybe I'll start with Jonathan for this one.
Yeah, you know, it's really interesting. I feel like there's, maybe this is too strong of a phrase. I feel like there's a little bit of doom and gloom around climate tech Series A right now, and that we see a pushing back of timelines. And you know, I think it's helpful to contextualize like where we are. I just actually saw some data from Carta this morning that the number of startups using Carta that went out of business in Q1 of 2024 was higher than any other quarter in their history. And it's just 254 startups. That's up like 60% year over year. It's not a perfect measure because the number of startups using Carta has also increased over that time period. But I think that like when we talk about Series A broadly, we say, hey, it's a really, really hard round to raise. But with climate tech more specifically, and I'll be interested to get Giancarlo and Ines, both of your perspectives on this as well. When I meet a founder who's raising a Series A, of course, there's the consideration, like, is this the right startup for us to invest in? But generally, I also feel like sometimes there's startups that I meet and I think, this is not a company that's going to be a fit for us, but they're going to raise a Series A. And generally speaking, because they have the validation points, they have the operational traction. And generally, I'm still seeing the rounds so that I think to myself, yeah, they're going to raise. Maybe it'll be from us, maybe it won't, but they're going to raise. Those rounds are getting done today. So I think that maybe my optimistic perspective is that companies that have the kind of operational milestones that we would have expected to be able to successfully raise a Series A, not in 2021, but in, say, 2019, 2018, those companies are still getting funded. They're getting funded, admittedly, on softer valuations than would have been the case a year or two ago. And maybe the operational milestones are slightly higher. The way that investors think about the long arc of capital needs for that company over its life cycle is maybe slightly different. But generally speaking, companies that are hitting those milestones, and it's not as simple as, you know, $1 million in ARR, but it's a great kind of baseline assumption. I see those companies getting funded regularly. Fundraising cycles in terms of how long it actually takes to raise a round are not materially different. And so I'm, let's say, cautiously optimistic that climate tech is a bubble of optimism in an otherwise somewhat challenging VC market.
Yeah, follow up there. How long should it take to raise a Series A?
there's no one right answer, but I generally tell founders that they should plan for as much as 4 to 5 months of fundraising, and that they should anticipate that they will need a number of months of cash in the bank at the conclusion of that cycle. So I've seen Series A raised in as little as 45 days and as much as 6 months.
Yeah, the old timing metric is, it's difficult to really measure. There are, of course, metrics, and you can look at Carta. They track the time between seed and Series A. Sometimes I see companies that are constantly in fundraising, and then they're announcing it. They're basically announcing it, and then suddenly they close it in. They claim that they did a fundraising Series A in 1 week, but in reality they were in fundraising for a year. The time is definitely expanding. Right now, we all know the graduation time is expanding. One positive news here is that there is definitely public money available that can extend you get the runway and give you a little bit more flexibility. If you look at and these are probably numbers that are not public yet, but if you look at the Bloomberg New Energy metrics, they track partnerships with the power sector, utilities in general. They basically, in 2022, they basically said there was a record number of mature digitalization activity, 150 roughly, and most of them were mature initiatives, so not pilots. And that was up. It was 65. It was up in 2021. Was 50%, and in 2020 was just single digit. So the utilities are definitely adopting more mature technology. But then in 2023, you had the GRIP funding in the US, and now you have the liftoff program from the DOE. So these are public programs, especially in the climate tech space, smart grid, generation, mobility, and they could definitely extend your runway and give you also flexibility to negotiate better terms. So just to end up on a positive note, these programs are out. They are definitely in 2023. There was a record number of pilots sponsored by this program, especially from the GRIP. And now you have the liftoff. So the 2024 numbers will most likely be influenced by that. I would definitely look at those programs as well.
Yeah, I think in addition to, I think I also definitely like to close on a positive note, and there I'm aligned with what Jonathan said earlier. I believe the companies that are doing well, they are and fulfilling the right metrics and have an attractive business model, that they get funded. And I think I also observe something with these companies, that they also build the right syndicates of investors in the climate tech space, so that they are combining really climate tech know-how of investors with maybe more other investors. And with climate tech know-how, I mean real climate tech know-how, so not maybe the generalists coming to that space now also investing in climate tech, but really people coming from that sector and having invested in that sector. And I think that's also something that can make you successful. And I think the good founders and teams also value that and need it. So I think that's the positive side for us investors. So that know-how is also needed and helps you also as investors win rounds in that space as well. So both for this positive side for investors and the startups, in my view.
Great. Well, thank you, Ines, Giancarlo, and Jonathan. Great discussion here. I feel like we probably could have gone on for another half hour or so with all the different perspectives and getting into, but we're going to have to wind things down here. So thank you everybody for joining and for the questions. We'll be hosting some more events in the future. So, look us up on LinkedIn, and hope everybody has a wonderful day. Thanks a lot.
Thank you.
Thank you.
Thanks all.
Goodbye.
Pleasure.
Thanks so much.